On my mind, gotta hustle and grind. Financial literacy always on my mind. I'm stacking knowledge, no time to waste. Gotta invest smart, gotta keep up the pace. I'm reading books, learning all the tricks, studying the market, making calculated picks.
What's good, everybody? It's your boy Reckless Raiding and we are back at it again for another bag talk. Today, we're going to be talking about dripping direct reinvestment plan. For those of you that don't know, that's where you just set it up. It's set and forget, easy street. I just set it to drip, and then it just builds. The position builds, and I look away, and then when I come back, there's a bunch of money there, and I'm going to tell you why, or not why, but when I choose to use this functionality within my brokerage accounts, and why I generally don't in regards to my high yield positions. Before we get into the conversation, don't forget to hit that like on the way in. Do not forget to hit that subscribe, especially if you've been here more than twice. Shout outs to the Wolf Pack as always. Got one of our members who sells cars. So for those of you who are looking for a vehicle, I high key recommend that you take a look at motorac.com, www.motor.ac. They sell cars. They can send them to your doorstep if you're within the continental United States of America. Great place. They helped me sort out a deal with a local dealer to get my new vehicle that I'm very excited about. If there hasn't been content already, by the time you guys are seeing this, there will be some coming because, we got to celebrate our wins before we put our head back to the grindstone and move forward. And, that's a milestone for me. But if you're looking for a car, they are the plug. Motor AC, www.motor.ac. That is not a paid promo. It's just, if you help me, then I'm going to love you forever. It's basically how it works. They reached out when they didn't need to. Obviously, one of our Wolfpack members, we will be doing business with them directly in the future. And, we do what we can when we can. But we're going to get into this conversation. This is a simple one. I don't have a whole lot of stuff to show. I will have some results to show, but that's about it. We're going to talk about when I drip. So when do I drip? When I start a position, generally speaking, I will set that position, and this is specific to my high yield portfolio. It is not the only portfolio that I have, but the other ones have taken a back burner as I am trying to be out of the workforce within the next 2 years, and or at least be work optional. Not necessarily, I don't know that I'll be out. I'm not the type of person who wants to just sit on a beach, but I do like to be able to come and go as I please. And, in order to be able to do that, if you have a job, you have to be able to quit your job and just be okay with that and still have income coming in. I also don't like the concept of having to go to a job. I'm really liking the space that I'm kind of inhabiting right now, where I'm a 2-income household. My portfolio equates to a girlfriend that makes less than I do, that goes to work sometimes, has a full-time job that's low paying or a part-time job that's well paying. And I like the liberty that gives. But if you're going to go hunt efficiently. We should be good at everything that we do. So for me, after my injury last year, it brought me to the conclusion that I need to not be 100% reliant on my body, because bodies break. And when your pay is tied to that, that could be detrimental for people, especially those of us who, like myself, are blue-collar workers, where all of our money revolves around our body. So that's just not a place that I want to exist in. So we're building up our income portfolio. We are going high yield. We are going high risk, high yield starting off. I do believe in that for myself to speed the process along. So like I ratchet my risk tolerance way up. I come from the crypto space, so you already have a high risk tolerance anyway. If you've ridden through those waves for as long as I have, since 2013, to put it politely, we've seen some stuff. So the risk tolerance was already there to begin with, but mathematically, it just makes sense to run hot at the beginning and then dial back as the portfolio grows. So we have some metrics in place right now. We try to sit at above 80% passive income per year annum, which is, I know, crazy talk in the traditional finance space. It is not that crazy in the crypto space. I mean, my compound annual growth rate for Bitcoin is above 50%, and that all I have to do is just buy Bitcoin. So having my passive income percentage where it is, I need to be at minimum above that. So as we dial back, I think we'll probably dial back to where we're matching the Bitcoin compound annual growth rate, because obviously if it's not going to beat Bitcoin, there's no point in doing it. Which means that dialing back to 50%, and I think 50%, I mean, as far as the volatility that you experience within the space of high yield, really isn't that high. But since we're on a specific timeline, on a specific trajectory, playing with those numbers, 80 to 80 plus percent, which right now we are sitting at 101% passive income rate, makes sense for me. As we get to some certain metrics, I'm going to dial that a little bit back. Now, what does that entail? Well, it's probably going to be a lot less single payers. I'm only sitting on one single payer as it sits right now. Allergies, fall allergies suck here. But as we're working through those payers, and as we get to certain metrics, so like once we get our dividend out income to the $40,000 mark, I will dial that back to probably about 70%. 70% I can deal with. And then we'll put less single payers, more collective, more low volatility, more risk mitigation, diversity as you would, because as you get to larger numbers, you want to protect the larger number a little bit. But I'll drip until the income becomes usable. I say this on every board, every forum, every post. I repeat it all the time. I am a heavy, at the onset, drip user at the onset, because until it's usable, then all the money should be cycling back in there to get that income up to where you need it to be to use it. Otherwise, you're just kicking yourself in the face. Like, until you've got at least $100 coming out of it, I don't see the point in trying to get fancy with things, unless you can get it to a point to where you can buy at least a whole share of the next position. I could see that being an avid play, but for me, generally, it's $100. Like, $100 becomes usable income for me, and once you get over $100, it's like, okay, well, we can use this to pay off a chunk of some distributions. We can use this to pay into a new position. We can use it to pay some bills. Because right now in my primary portfolio, the one that we're actively using to pay for all sorts of stuff right now, we've got debt management coming out of that. We've got a little bit of growth coming out of that, a little bit of reinvestment back into the portfolio. But we've been dialing that back as we're focusing on crunching down this debt, because like I'm starting to see how the consumer debt stuff, if you're not sitting in 0% interest positions, or in a position where you can just clear the debt like as soon as it comes back around, it can just grow. Like, we're doing the debt crusher episode, like that bad boy fluctuates based on what we're doing that month. Like, it's just what it is. So we're actually putting Sauron's eye on it now. We had to buy a vehicle, which entailed spending a little bit of money. So this month got derailed. We ended up in a space where we're over saving again, and the debt went a different direction than what we wanted it to in the month of October. Because yeah, this one will still be in October. So the month of October, we kind of messed it up a little bit. We're going in the wrong direction again a little bit, but now that we're moving forward, this last, like, I'm getting ready to pull some payments. We're doing some shifting around in how we're utilizing that margin pool now that we're keeping it a lot slimmer for our primary, which is the one that pays for stuff, to streamline that debt payoff. And I think moving into November, I keep saying this, that we're going to be making some moves forward. I think we're going to be making a little bit of move forward to at least keep us in breathing realm coming up. But you know, we've got a couple of more stupid expenses to get out of the way, and then until I go on my one vacation for next year, we should be clear sailing to just buckle down and save some money, because I don't have a lot of stuff to buy, and most of my plans are going to be for, or any future purchases are going to be hopefully for not until around spring, that are going to be large purchases, and we're just going to be dead set on paying off debt before it becomes problematic. And yeah, so that's kind of where we're at, what we're doing with that. The other thing that we're looking at is investments. Obviously, we're wanting to roll those distributions over into investments. Now, my problem that I've been having is we're over investing, which means that I will run further into debt to get more assets, because the overall numbers, even though the debt's going up, I'm going in the right direction, which kind of, it's counterintuitive, and it annoys me because I just don't want the debt. I don't like paying money to have money out. Like, it's not like I'm out buying TVs or you're seeing me flossing stuff on this channel. I'm not even doing that. Like, this is just like me existing, but like my brain is so tilted towards just buy assets, buy all the assets you can, because of the space that we're in. It's either spend all your available cash, which may also make sense right now, because if you save it in cash, your money's burning up, or you just want to buy all the assets possible so that you can be even more secure on the right side of the trade. And it's like, hey, we're secure on the right side of the trade. We got to clean up the mess now a little bit. But I digress. So I will drip until the money is usable, after which I do not believe in just indefinite dripping. It does not make sense to me. I also, if my income, my W-2 income was higher, I would just buy Bitcoin. I also don't see how people who have a lot of money just rush into the space and they're like, yeah, I just put like $500,000 into high yield. Oh no, why did the price go down? Oh no, why am I doing that? And it's like, you could have just went and bought a few Bitcoin and just chilled, bro. Like, could have taken loans against the Bitcoin and used that to buy the high yield, and then use the high yield distributions to pay back the loan, and just kept that flywheel churning indefinitely, and not risked your whole bag, and had plenty of collateral behind it so that you're not worried about it. It's the high yield space for me is the poor man's Ruger, man. It's a tool that's used for those of us who don't have income but are financially literate. So like, if you do understand how money works and you just don't make a lot of it, and you don't want to go into debt to get replaced by AI, this is something that we can use to work our way out of those positions by building up an income base. Because if you're that good, the income that you're capable of generating, you can accelerate the money that you're making. You should be able to get positioned to get to where you need to be. If you're already rich, there's just better plays. Like, it's better to just buy Bitcoin. Like, if you're a high income person, it's better to just buy Bitcoin, take loans against Bitcoin, pay for stuff, and then use your income to pay back the loan that you took against the Bitcoin, as opposed to, running up credit card debt. It just makes more sense mathematically. Like, you'll end up further ahead down the road. This is because I can't get further ahead. Like, I can't buy Bitcoin and sell Bitcoin and still have a whole Bitcoin. Like, I'd be nowhere close to a whole Bitcoin. I'd be eating myself as I'm doing it, as with any growth product. So this is it acts as a crutch, and I'll give that. The other thing that it does is it provides supplementary income. You can use it for that. Like, it's a great tool for that. But like, You could also use it as primary income if you have the backing of some good growth for when the income isn't as great, because it is variable. But as far as a be all end all, like, no, I do not. This is in addition to, and then you're building out portfolios so that way you can go, hey, I've got income, I've got some growth, and I've got some Bitcoin. I've got three tiers of I have something to tap into if things go south. I don't believe in just like putting all your eggs in a singular basket. If I was going to put all my eggs in a singular basket, the singular basket would be Bitcoin. My singular basket is Bitcoin. All the rest of the stuff is built around to make sure that I can spend that last. And so I don't drip high yield after it gets to a usable amount of income. It just doesn't make sense to me to do that. So what are the results? Let's bring it to the screen. Go ahead and make myself a micro machine over here. You can see now I'm recording this towards the end of October. This will be the last Thursday of October that this video goes up, I think. No, this will be the first video of November. So welcome to November. Bam, time's flying. But this is being recorded at the end of October. So as we can see, we've come through that ulti dip. Ulti is down around the $5 range. We dipped under $5. For those of you who bought the dip, good on you. For those of you who didn't, great. Those of you who capitulated at a loss, ouch, that's crazy. Ulti is one of my predominant picks because at the current levels that I require for my portfolio, Ulti is and has been a foundation for me. And obviously my cost per share over here is $5.84. I did get it under $5. I was buying in the sixes. That's when I started buying. And as you can see, total profit, we are remaining flat while I am still getting paid, which means that I'm getting paid more than what the price is going down. And this is the metric that I make all my decisions off of. This is where those decisions come from. If I need to cut a position, if I'm going to keep a position, when we start getting into like 5% red, that's when I start making cuts, 5-10% over here at the total profit numbers. As we can see, what else was I going to talk about over here? As we can see, so we've kept flat. We've been keeping our payments distribution going out. Ulti has bought in a lot of payments. It's paid off a lot of debt so far. It's been paying off chunks of it. It's been managing debt. We can see our blocks is down a little bit low. That's the one thing that we still have left in the red. Stuff goes down, stuff goes up. The thing to remember with these high yields is when stuff goes up, it goes up slower. So like you're kind of waiting a little bit. As far as the next in line, when we ratchet back, we'll be rolling out of this Ulti into the wpay. That's going to be my next one. I like this. It pays well. It's over 70%. Good foundational base. Ulti ratcheting up high. The dividend yield now is at about 93%. So for me, I'm like, hey, they're keeping consistent payment. The NAV is going down. If I'm scaling out of risk and volatility, then the move is to move into wpay. That's the next one down. I got my TSYY solid, been doing great. Got no complaints about this one. Tesla is a share that I'm looking to add into my portfolio as well. So we're doing good there. This one runs hot, single asset, 140%. We're in the 140s. Awesome. Blocks, cash reserve position, very flat. We're going to be continuing to buy into this. Now, this one is a lower payer. It's 35%. That's well below. But for cash reserves, we don't want things active. Like I want boring in a cash reserve position, and blocks pays well and is more or less boring. It's tied to the cryptocurrency space. Crypto go up, we go up. Crypto go down, we go down. And that's basically like buying Bitcoin, and it also pays well with little bit less volatility because it's not nuking itself. Granted, when Bitcoin dropped, it did because the crypto industry dropped, but that was to be expected. The complement to this, after we get this to kicking off $100 a share, this will be used to buy stretch. Then whenever I have to cash out or use cash reserves, we'll have the stretch income to play with. We will also have the stretch position in and of itself to sell off before we sell off blocks. Like, I want to keep this as a stalwart in here, and just producing my cash reserves produce money. So it's a incremental part of our portfolio. This will be set on drip until we get $100 a share. That's kind of my logic on how I go about utilizing drip. I use it strategically. Now, if I have like my bank stocks, like the shares that I buy every month, that are my monthly, that are in the long-term portfolio, those stay on drip, and I just don't look at them because those are things that I buy every month. And unless I'm getting rid of the position or rolling the position into something else, I don't really worry about it. But that's my methodology on how I personally use drip, because I'm very active with my portfolio. I'm very active with my money management. So I don't want to leave that to chance. I don't like looking away and not being able to navigate as I see fit based on the constraints that I put in for my positions in the portfolio. And I feel that from a mathematical perspective, if those positions were just left dripping, they wouldn't make as much money as if they were paying off debt, in my opinion. Now, usable income for outflow of the portfolio is $250. That's when we start looking at what goes on outside the portfolio. Couple of other things that are being managed now, though, is the personal loan that we took, that we used to buy the car, that we also putting about a little over $10,000 into the markets to backstop that and also pay back the portfolio. So we have a payment that goes back into paying that loan every month. Now, I've done some research on the SoFi loans. They're pretty interesting. You can't prepay your automated payments. So if you pay extra, it doesn't go towards the payment, which was what I thought it did. I was like, oh, well, this just goes a little bit ahead and like it does X, Y, and Z. And it doesn't. So what we've done is we're pulling money as we pull money over. I'm just putting it in my deployment savings account. Like, all my bank accounts have 3 accounts. I've got a little deployment savings account that sits, it's a tertiary account. It's the third one. And we're using that to just have the loan funds built up in there. And we might make it to where like a little bit of the extra overspill or whatever goes in there as well. And then, we'll make a separate payment for the overspill or something. Like, I don't think or actually what we'll probably do is that overspill will most likely just put into Bitcoin, to be honest. There's no point in paying it off early at this point until I'm ready to pay it off. And then it's like, cool, I can do double payments the second 12 months or whatever. But as we're moving forward with these first couple of months, we're going to take a look and see how that plays out. Because we're going to be over invested next month because I was trying to cut myself off at $1,500. I'm still going to have loan money that I'm dollar cost averaging into the market. So my first inflow next month, I'm already covered for the month. Like, I just can't spend any more money, which means that like all the direct deposits and all that stuff just go towards knocking out margin. And I'm fine with it. Like, I'm good with that. We just got to follow the playbook and keep that margin managed. But we're getting ready. We're going to have a margin pull at the end of the month, and we're going to pull all of it and disseminate it accordingly. And, make some more moves, start chunking down this debt and getting this stuff out of our face. But yeah, that's my ramble and my take on drip. Hope you guys liked it. Let me know down in the comments. Let's talk about it. Are you guys dripping? Do you drip indefinitely? If you do, why? I'm assuming that a lot of you hold stocks that do like quarterly dividend or like a S&P, which those positions would be in my long-term portfolio, not my high yield portfolio. So those would just be set and forget drip. So that way I don't have to worry about change accumulating in the portfolio. But for high yield specifically, I do not drip beyond it getting to the usable income range. And once it gets there, drip turns off, never gets turned back on. And as it's set so far, that's been what's working for me most efficiently. Now, this is a year of trial and error. I normally go a quarter with my little experiments and my tweaks in my portfolio. I try to give it a full quarter to get a feel for it, to see what it's going to look like. And this iteration, every quarter, we're getting a little bit better, getting a little bit more, and getting a little bit less worrisome about this. I'm starting to feel about the high yield space the way that I feel about Bitcoin. I'm starting to get not necessarily comfortable, but I have my flow on how I like to have my portfolio work. And most importantly, it's working. So that's what I got for you. This has been another Bag Talk. Do not forget to like, share, and subscribe. We're getting our way out there. We're flirting with 400. We want to get to 500 by the end of the year. I think we're going to make it. Till next week, it's your boy Reckless Ray Dinero, and I'm out. Peace.
Money on my mind, yeah. Focus, got no time for games, nah. I don't play it, I'm all about that financial literacy. Investing in my future, building generational wealth. Dollar bills, they be calling my name, but I ain't chasing fame, I'm chasing change. Learn the game, now I'm playing it smart. Putting my money to work, it's an art. I'm stacking paper, building my own empire. No more living check to check, I'm getting higher. Investing in stocks, real estate, and more. Gotta secure the bag, that's what I came for.